All right, we are live. Thank you everyone for joining us. And Brad, welcome back to the channel. How are you, my friend?
Thanks, Tom. I am fantastic. Had a beach day, so I'm feeling loose.
Yeah, that's good. You see, I got the hoodie on. We're coming into winter
no.
in New Zealand, so I'm very jealous of that. Yeah, we had a pretty warm summer, so I can't complain. But we're about to batten down the hatches again for the next couple of months here. So
Yeah.
I'm very jealous. But we were just talking before this. The previous Seritage Growth Properties live stream we did was one of the more popular videos on the channel now, and it's been sort of a few months since we did that stream. I think that was September last year. A few things have changed. A few things have kind of remained the same, and I think both of us continue to get a few questions in the comment section and so on about SRG. So it seems like a pretty good time to do a bit of an update and see what questions other people have as well. So you're ready to get into that?
There's a lot of interest in SRG.
Yeah.
Even for the whole short squeeze thing. So excited to dive into it today.
Yeah, that's actually something I haven't noted down in my notes to go through the stream, but we should talk about that short squeeze if we get a chance. Cool. And we got some people starting to join in. It looks like Frank's about to regret selling his SRG shares. Nice one. One thing we should disclaim right before we get into this is entertainment purposes only. If you go out and buy SRG and make a massive gain, I'm not going to come to your house and try to get a percentage. So if you make a massive loss on SRG, don't come to me or Brad and complain about it. So entertainment purposes only, of course. But yeah, let's get into this thing. So Brad, how did SRG first come on your radar?
So seeing that Mohnish Pabrai had to file a 13G really perked my interest. He bought, I think it was like 12% of the company back in May of 2020, because that 13G showed up June 10th. And so that's when I really started diving in. I wanted to get a handle of, okay, what are the individual properties worth? What could they be sold for in a fire sale? And we went through that in our last live stream, what I thought, each property could be worth. So yeah, and then of course Phil Town was involved. Warren Buffett had bought in, in 2015 when the company was first spun off from Sears. A lot of big names, right? Who am I missing? Guy Spear.
Yeah, a lot of big names for a $1 billion market cap company. It's not some massive business that everyone's heard of. It's kind of flying under the radar, yet it's attracted all these big names. And Eddie Lampert, of course, is kind of running the show at SRG as well. So yeah, I guess maybe to sum up the previous live stream we did, if anyone hasn't seen it. So there's basically two, as I see it, sort of two elements of the SRG investment thesis. The first thing, which we, and you did a lot of the grunt work on this last time around, was looking at basically the net asset value of Seritage. And I think you came out with about $35 per share. At the time, it was trading at roughly $12 per share. And I was just looking before this, since we did that stream, it's fluctuated quite a bit. It's been as low as 11 and as high as 23 in the short squeeze and around the GameStop time. So that was sort of one part of the thesis, is that you're getting this big discount to net asset value. The other part of it is, I guess, SRG does have a lot of negative cash flows right now. So if you're simply buying it just for the discount to, say, liquidation value, if that liquidation value is just going to go down indefinitely, it's probably not the ideal investment. So the other part of it is that SRG have this big redevelopment pipeline. So initially the real estate was spun out of Sears. They're looking to redevelop a lot of these properties in order to basically multiply the rent per square foot that they're getting for those, real estate assets. But also one of the bits of the puzzle that I think we'll get into in quite a bit of detail today is they're also potentially expanding a lot of the square footage at some of these properties, which in turn creates a lot of potential value and rental income and so on for SRG moving forward, right?
Mm-hmm. Right.
Is that basically the thesis for you summed up? Is there anything else you sort of think about?
Yeah, I think that's about it. There's kind of a cap on the downside in terms of what the properties are worth, particularly kind of the 5 to 10 really premier location properties. And then, if they can really develop those into something, 10, 15 story mixed use properties. I mean, you're talking about very valuable properties in Santa Monica and, Miami, some of these premier locations. So there's a lot of potential upside. And from what I'm seeing, fairly minimal downside, as long as, things are moving along in the right direction.
Yeah, agreed. Yeah. And we should both say, I'm an SRG shareholder, and as far as I'm aware, you still are, Brad.
So yes, I am.
There's our biases out in the open before we get into the details here. So, let's kind of go through some of the things that have changed. So, probably the thing that rises straight to the top of the list for most people is that they've had a change in CEO since we last did a live stream. So. The previous CEO was a guy called Benjamin Shaw. New CEO is a lady called Andrew. I've written Andrew on my notes. That's Andrea. Not correct. Andrea Olshan, who has recently come into the business, and there was a bit of overlap of those two CEOs, and there was actually a short period of time where there was no CEO in the last quarter. So there's still sort of very fresh news. As far as I can tell, it looks like Ben Shaw basically moved on to bigger and better things. He went from a REIT, being SRG, with a market cap of, call it $1 billion, and he's gone to Avalon Bay, which has a market cap of closer to $30 billion. Is that kind of how you see that movement as well? Did it throw up any red flags for you?
Well, it always makes me a little nervous when there's turnover at, upper management levels, but it seems like what happened is, like you said, he was in the limelight of Berkshire Hathaway and Eddie Lampert. And, because of that, there were larger companies that wanted him. He became pretty desirable to those larger REITs. And, it makes sense if you can make 3 or 4 times your salary somewhere else, that can be a pretty strong motivator. And he didn't really have any skin in the game with SRG. He didn't own much equity at all. So it didn't seem like there was much preventing him from leaving. And, some of the people that I've been following the super investors who are involved in SRG, don't think, the CEO, the management team is necessarily super critical for a company like this developing these properties. And so, it didn't make me too nervous with the turnover in the C-suite.
Yeah, I agree. It's not like someone replacing a Jake Jane at Berkshire Hathaway writing massive, unusual insurance contracts with huge liabilities, right? It's an industry with a lot of people that have a lot of expertise. So, Andrea Olshan has come from effectively a family real estate business, right?
Yeah.
And she, in my experience, has actually been quite difficult to find much information on. So that's about the extent of my knowledge, to tell you the truth, of the new CEO.
I made a video on it, like Scuttlebutt, Andrea Olshan, and there was very little. I mean, I found there was a video, it was like a private video on YouTube. So you needed the specific link. You couldn't search it, like a 12-minute interview at some REIT conference with her. But there's not a whole lot out there. So, we're just gonna have to see how things unfold.
Yeah, agreed. And I see we've got some good questions coming in already. So definitely keep those coming. The plan for the stream is, unsure how long this is going to take, but we've sort of got some bullet points of notes and things that Brad and I are keen to talk through to kind of get through as much of the update as we can. And then if it's cool with you, Brad, I think we'll just take as many questions as we can.
That sounds great.
The end. Okay, cool. All right. So the other thing that's happened in terms of management is there's been a bit of a shake-up or restructure, I suppose, in what you'd call the C-suite. So the chief operating officer, chief investment officer, executive vice president, and chief accounting officer, as I've noted down, have all changed. So as far as I can tell, pretty much all of those people were actually already at SRG, perhaps with the exception of maybe one of those roles. Again, I don't know what sort of impact that's going to have internally with management at the business. That came out in a press release from SRG only within the past few weeks as well. So that's something else to note. So I guess if we jump into maybe some details here, Brad, one of the cool things that you did last time, like I mentioned, was you went through and basically collected comps for all of SRG's properties.
Right.
Did you want to maybe speak a bit to how you view those comps now? I know SRG have gone on and actually sold some of the properties that you worked through and tried to estimate the value of. So do you want to maybe talk to how close, your assessment was versus the actual sale price and so on, and how you're thinking about those numbers today?
Sure. Yeah. Back when we did our first live stream in September of 2020, there were 171 wholly owned properties from SRG. As of the latest quarterly release, they have 154 wholly owned properties. So they've sold 17 properties. So what I wanted to do is figure out which 17 properties they sold, what was my estimate of value, and then what was what did they actually sell the properties for, to try to get a sense for, overall how accurate do I think my comps were. So the results of that, unfortunately, they don't break out which properties they got X amount for. So there's no kind of direct comparison I could make. So what I did, I could see that they sold 6 properties in 2021 so far. Okay, Q1 and what we've been into Q2 so far. So those 6 properties, they sold for $63.2 million. So that's $10.5 million per property. And then in 2020, they sold 27 properties for $333 million. So that was about $12.3 million per property. So my average comp value for the 17 properties that disappeared from the list since we last did this live stream was $14.5 million. Okay. So it was a little bit higher than what they were collecting on average this year and last year. But there's such a range in the comp values that I came up with. It's like $1.5 million to $43 million was the range in just those 17 that disappeared. So, it's because there's such a big range. The bigger values in my comps can really throw off averages. So I don't know that averages is a great way to go about comparing these things. Might be better to do median or something like that. But I think it's close enough that I'm not inclined to go through and try to redo all of the comps. Slightly high, but not alarmingly high. I think still kind of within an appropriate range.
Yeah, cool.
Yeah.
And one of the other things I guess to keep in mind is when SRG are selling some of these properties, the reason they're selling them is to basically fund the redevelopment of other properties, which are presumably have much better economics if they're to, essentially monetize some assets and spend that cash on redeveloping others. So potentially there are some properties that are, I guess, on the lower value end that they may be selling. And the other thing that we'll talk through a lot today is there's some properties that are in your comps that, in my opinion at least, are massively undervalued post redevelopment. So that's something else to keep in mind as well. And
these aren't post development comps.
Yeah,
right? These are based on what they are now. Yeah, as they stand. So what was I going to say about that? Right. So there's kind of 2 ways to think about them selling properties. One is, oh man, these guys, their list of the properties that they own is just dwindling and dwindling, right? There's a way you can kind of panic about that as an investor. Another way to see it is, their end game here is they want, 5 to 10 to 20, whatever it is, premier developments. And that's actually, so them selling properties isn't an admission of, oh, this isn't going the way we want it to. It's actually the game plan. And I think a lot of people miss that.
Yeah, agreed. Yeah. Well, let's talk about that, because to be perfectly honest, that's something that's really only clicked for me in the past few months. So, we've had basically 2 investors that are in SRG that we both like and admire quite a bit, being Guy Spear and Mohnish Pabrai, and they've both come out and basically outlaid a lot of the ways that they think about SRG. And Guy Spear was the first one to do that, and the way he essentially described it is he thinks that The way I'd always viewed SRG was they're going to redevelop some properties and they're going to get this multiplier in rent per square foot. So they're going to go from $4 or $5 a square foot initially, redevelop a property, and then get closer to $18 or $20 a square foot, or even with some of their more recent leases into the $30 a square foot range. So that's the way I had always pictured it. And I guess I was thinking about that kind of as a vast blanket across their entire portfolio is probably how I was thinking about that initially. But one of the things that Guy Spear has come out and said is that he sees most of the value for SRG being created at only a handful of properties. And Mohnish Pabrai then went on to say in a recent podcast that he basically sees the same thing. Like you mentioned, he sees SRG probably getting down to only 20 or 30 properties, but they're going to have some of these properties that potentially have, this huge densification, as he described it, where the square footage is not only going to get rented out at a higher rate, but it's actually going to be a much larger square footage in general. They're potentially like 10x in some of these examples, the amount of area that they can rent out.
Right. Because most of these properties are single story retail, right? Sears, you think of Sears.
They're Sears stores, yeah.
So, if you have a mixed use, say multifamily above retail, you're building up, which means, you can 10x your square footage on the same footprint, which, some people miss that as well. It's just a huge kind of leverage effect there.
Yeah, for sure. And we'll get to this maybe quite a bit through the stream as well, but that's changed the way that I actually think about some of your property values as well, Brad. It's sort of, I'm now focusing more on some of these premier properties where they do have this big opportunity for expansion. And I'm really viewing the rest of the properties almost as cash, as strange as that might sound, because effectively they're just offloading properties as required to fund these redevelopments. And they're going to be left with a much smaller concentrated portfolio of really high quality assets. Is that how you're starting to view it as well?
That's how I'm seeing it. Yeah.
Cool. Okay. Did you listen? I'm assuming you've listened to that Pabrai podcast and heard him
Absolutely. What was that, like a week ago? It's pretty fresh.
Yeah. Pretty recent. So if anyone hasn't heard that, that's he was on the Investors podcast with Stig Broiderson. So go and check out that episode.
Fantastic. Yep. It's
very
great
good.
talk.
So shall we get into one of the examples that Pabrai actually brought up?
Yeah, let's talk about Dallas, Tom.
Yeah, cool. Okay. Well, this is a quote from that podcast. So Pabrai said, if you take a 10 or 20 year view of Seritage, the portfolio will get down from 180 properties to maybe only 30 to 40 properties, but they will be ultra prime and will go through very significant densification. So that's basically what we just talked through. And he bought up this Dallas property. So what's happening in Dallas, Brad?
Yeah, let's talk about Dallas. Are you able to pull up any of those links, Tom, so people can see, kind of share your screen, or is that?
Yeah, I'll give it a go. Just one sec.
Maybe just that second link there in your Word file.
Yeah, sure. We will bring that up. I think this is going to work. Bear with us for a sec, everyone. Right. Share screen. That one. Okay, can you see that, Brett?
Yeah, can you click OK just to expand it a little bit? Yeah. Okay. Perfect. So this is Park Heritage in Dallas. As you can see, this is a wholly owned property by Seritage, not a joint venture or anything like that. And this one, they're looking to, what is the footprint square footage? 235,000 square feet.
Mm-hmm.
So it sounds like they have big plans for this. They've already gotten approval to expand it to, is it like 2.1 million square feet, Tom? I think so. It's like 10x what it is now.
Yeah, so this is interesting. So on the podcast that Pabrai did, he actually said 3 to 4 million square feet. But in some of the digging that I've done, I found a few sort of write-ups on this redevelopment, and they're talking about 2 million square feet. So whether that was Pabrai misspeaking or whether he thinks the development could get even larger than SRG have talked about. I don't know, but nonetheless, it's a massive expansion. So they're going from 235,000 square feet to probably closer to 2 million square feet. And that again is going to be kind of mixed use property. So the breakdown on that 2 million square feet is about 1.1 million of Class A office space. They've got a bit of a range here on multifamily units, but call it ballpark 700 multifamily units. And then also about 275,000 square feet of retail, restaurant, and entertainment space. So huge expansion. And I guess I'll just stop sharing my screen on that one. But I guess if you start to think through how that impacts a couple of things for Seritage, so the amount of rent that they can actually get in the door and how that actually translates into property values, the numbers start to get pretty large. So this is kind of the way I'm thinking about it at the moment. Brad, we were talking just before this. You've actually done some work, a bit of scuttlebutt on trying to figure out what some of these properties might rent for. Did you want to maybe talk through that first, and then I'll talk through how I'm kind of thinking of turning that into a actual property value for this thing?
Yep. So there's, 3 different types of real estate involved: residential, which is like apartment units, office, and retail or restaurants. So what I did was I went on to Craigslist, and the cool thing about Craigslist, you can do a search based on radius. So I just plugged in the zip code for this Dallas location, did like a 2 or 3 mile radius, and tried to figure out, okay, what are rents in the area? And of course, they're talking about here Class A office, which would presume it's also going to be Class A multifamily, right? Class A apartment units. So in this area in Dallas, we're looking at around $26 a square foot. That's kind of annual rents for Class A residential. For office, I saw $33 per square foot, and then retail around $25. So if we want to be conservative for Class A, we could probably say just kind of lump it all in at $25 per square foot. But more work could be done on that to really drill down further. It's also helpful to know, are they, how many 1-bedroom apartments are they planning? How many 2-bedroom? Things change a little bit with that equation. But I think $25 a square foot is reasonable for what they're planning to build.
Yeah, cool. Okay, yeah, and then I guess the process that I'm sort of thinking through in terms of actually turning that into a property value for SRG, I'm kind of looking at what they're potentially going to bring in rent. So if we stay conservative, like you say, and use, let's call it $25 a square foot across the 2 million square feet, that's about $50 million annually of rental income off that entire Dallas property. So, I mean, you're probably going to have some vacancies and other things in there, and we're probably being slightly conservative with the rental price anyway. So hopefully that's already factored into the numbers I'm talking.
Hopefully we get 3 to 4 million, right, Tom? Square feet. That'd be great.
Yeah, exactly. So we're trying to stay on the lighter side of this thing and leave room for upside as we always should. So let's call it ballpark $50 million in annual rent. SRG are obviously going to have some ongoing costs on that, so that's not pure profit. I actually looked through what I think's a somewhat comparable REIT called Simon Property Group and kind of looked through some of their financials, and they've kind of been trucking along at slightly over an 80% gross profit kind of percentage, gross profit margin. So if we take that 50 million and rent and apply that sort of 80% margin to it, we land on about, call it 40 million. Hang on, what's my numbers there? Yeah, so if we go 50 million times 0.8 to get a gross profit amount, and then we apply a 6 cap to that, which is what SRG have been able to monetize a lot of their properties for. Some have even actually dipped into the 5 cap range, which would increase the property value even further. But nonetheless, I'm landing on about a $670 million property value, assuming that they're able to go through that redevelopment kind of project and achieve that level of rent.
Yep.
And in the grand scheme of SRG, a $670 million value of one property is monstrous. So I'm just gonna share my screen again here, actually, just to bring up a couple of numbers. So if I go to that one, cool. Are you guys seeing Yahoo Finance at the moment?
Yes.
Okay. I'm just going to go to
you
Seritage.
Guys, you mean me?
Yeah, you and
the
we might get I think we're on a few seconds delay to the commenters, but we'll eventually get told if they can't see it. Anyhow, so I just mentioned $670 million property value. The current market cap for all of SRG is $940 million. So that's a monster percentage of the market cap. Of course, Seritage have got a reasonable amount of debt. So if you look at it on an enterprise value basis, that's $670 million on a $2.4 billion enterprise value.
So more than a quarter.
Yeah, more than a quarter. It's about 28% of SRG's current valuation from one property. So that's massive. And I think they've come out and they've got a few press releases out there where they're talking about certainly more than one example of a property like this. I think, Brad, you've identified potentially up to 7 premier sites that they're talking about. So if they can get even a couple of these off the ground, you start to get to some pretty large numbers pretty quickly relative to the current valuation of SRG.
Yeah, I think it was in their latest earnings release. They talked about some of their premier developments, and they talked about Santa Monica, Miami, San Diego, Redmond, Washington, the Dallas property. And then there's Linwood, Washington, and Alexandria, Virginia. So those are, and a number of those are joint venture, but some of them are, just Seritage. So, those would be, if I were considering buying Seritage today, I would dig into those 7 properties as deeply as I could, just to try to get some sense of, what is the upside here.
Yeah. Agreed. Yeah. And of course, I mean, not every property is going to have probably this level of square footage expansion, if that's even a term. But they've certainly got a few of these. So
I mean, one thing you could do is just look, okay, in that area, in the area of these different properties, what are building heights for mixed use or something like that, to try to get a sense what might get approved if they were going to go that route. That's one way to do it.
Sure.
Yeah.
Very cool. Did you have anything else to add on the redevelopment, Brad, or is that, you think, a reasonable overview of how you're seeing this at the moment?
Yeah. I don't know in terms of Dallas what Class A is currently selling for. That might be interesting. Have you looked at that at all, Tom? The 6 cap rate, it sounds like that might have kind of been an average of what they've already sold. But I would imagine that a property like this would be, higher value or a lower cap rate than a lot of what they've been selling recently. So, I mean, 6 feels okay to me from a conservative standpoint, but I could see even 5s or 4s being realistic.
Yeah, true. I don't know. I see we've got Jack Duffley in the comments. I don't know if Jack has anything to add on that. He's the real estate man. So
that's right, our real estate guy.
But I mean, the thing that's really going to drive this is obviously the cap rate's important, but at the end of the day, it's how much income can SRG start to generate from this, because currently they've obviously got this big cash burn, and they need to reverse that at some point once they've kind of gone through this redevelopment. And then, if they can genuinely get through that, I think even if you use a very conservative cap rate, the numbers start to look quite attractive. Again, we're sort of trying to get ourselves into this asymmetric downside upside balance, right?
That's right. It's what we want.
Yeah, absolutely.
And it's gonna take time for this to play out, right? This isn't, I think a big part of why a lot of market participants aren't interested in Seritage, it's not a year or two kind of play. I don't think. I think it's more like a 5 or 10 year play, and a lot of people just don't have the patience to be involved in an investment like that.
Yep, agreed.
Yeah.
And that's the main risk for Seritage, is that if this doesn't work out, it's going to not work out probably over a long period of time, and you've potentially wasted a lot of time in this thing. So we should definitely put the bear case out there, and that's kind of what it is. It's SRG dying a long, slow death, I suppose. So something to keep in mind for sure. But I agree. To be fair to some of the more bearish people out there, SRG have been telling this story for several years now, and of course the lockdowns and so on didn't help them. But this one's going to take them a few years to get to the other side of.
Right.
Cool. I guess there's just one more bit of maths and kind of valuation stuff that I was interested in sharing, and then maybe we can get to some questions unless you have anything further to add,
let me just, I pulled a few numbers from apartmentloanstore.com. I don't know how high quality of a site that is, but brings up some cap rates for Class A. So retail in Dallas, 5.4, and office in Dallas, 5.6. So that's a few recent numbers from 2021. Again, I don't know how legitimate those are. Just a quick search.
Yeah. Okay, cool.
Yeah.
All right. So I guess there's a couple of big questions here as well for me, which is, obviously on the other side of this thing, the income or the rent generated from these big redevelopments looks pretty attractive. But the big question, and I see there's a few comments sort of getting near what I'm about to say also going on, which we'll definitely get to. But the big question for me is, I guess, how long is it going to take? Because they're currently got a lot of negative cash flows, and you can only run that engine so long. And the other part of it is, obviously going through these redevelopments is a very expensive exercise. So if you're spending cash to do these developments, what return are you actually generating on it, right? So I've pulled an extract from SRG's latest 10Q, and they actually gave some figures on some of the redevelopments that they're currently going through, and then also the expected rental returns that they're getting from them. So the first example they gave is they're going through a $46 million development, which they expect to get about $13 million in annual rent from. So
can you pull up an image of this thing you're pulling from, Tom, or would that be too challenging?
That might take me a few seconds to get to, but if you want to pull up the latest 10Q while I'm talking about it, that would be useful. So they've given a couple of examples. So 13 million in annual rent from a $46 million development, which you don't have to be that good at maths to realize that that's quite a high return on capital. So the number that I get to there is about 28% return on capital from that, or return on investment from that redevelopment project. And the other way that I was thinking about it again is trying to turn that extra rental increase into some sort of asset value for the property. So again, if you apply that sort of 80% gross profit margin on that 13 million of rent, and apply a 6 cap, I'm getting SRG basically spending, call it 46 million to go through the development process, but creating about 170 million in asset value by doing that, which is a substantial multiple. And the other example they got is not quite as extreme as that one, but they said they're going through a $39 million development where they expect to get about $6 million in extra rental income, which is about a 15% return if you just divide 6 by 39. But again, if you turn that into some sort of asset value increase, you're looking at spending about 39 million to get about an $80 million increase in asset value. So that's sort of how I'm viewing some of those redevelopments as well.
Nice.
Did you manage to track that down at all, Brad?
I haven't. No.
Okay.
Yeah.
the viewers will have to take our word for it, or my word,
or dig into the financials.
Yeah, of course. Yeah, do your own work as well. Just don't just listen to us talking about it. So I believe that I've written down in my notes that came from the latest 10Q. So if you look up the latest 10Q from SRG, anyone that's interested in tracking that down, you should find it there.
Cool.
Cool. Well, that's all I've got, Brad. Have you got anything else that you think warrants updating?
Well, the one thing I did notice recently, because there were like 2 million OP units that were converted into Class A shares in the last year, Buffett is no longer listed as a 5% owner. And I worked out the math, and it does seem like it was because of those conversions from OP units to Class A shares. So that's kind of a bummer. I mean, it's always nice to be able to see that Buffett is still an owner, but I don't think we can do that anymore.
Yeah, fair call. And I think you've made a video on this question that I might just pull across from Frank as well, about Eddie Lampert selling some of his shares. Do you have thoughts on that, or some other things we should be considering when we calculate that percentage of his shares that he's selling?
Yeah, I did the math, and I don't think it was 25% of his shares. Frank, were you considering his stake in operating partnership units as well? Because I think if you factor those in, it was like a 5% or something reduction in his position. But
yeah, that sounds about right. It may have even been slightly lower from memory, but I don't think it was anywhere near 25%. But
because from the last time I calculated, it looks like Eddie Lampert owns around 37% of Seritage, and the vast majority of that is in these operating partnership units, not in Class A shares. So it's kind of a sneaky thing with Seritage.
Yeah. Cool. And just the other thing while we're talking about Buffett, so Buffett didn't sell, to be clear. He's just been pushed under that 5% reporting threshold. So we're not going to be able to see if he does sell or anything like that. So the other thing on Gurus is we also had, we also had Phil Town make a change to his position, right? So he was coming out right before we did the last stream saying, guys, the dirt's worth $17. SRG's going to 50 or 60 in the next few months, and I think it's worth 140 in 10 years. I think that's about what he said.
That is what he said. I guess he didn't have very high conviction of that.
Yeah, so he got out right around the CEO, right around Ben Shaw resigning, right?
Yeah, I think like maybe it was around 14 a share at that time, something like that. But I guess one of his funds he sold out of Seritage. The other one he didn't. And I think the one he sold out, he bought in a bit lower, maybe in the 7 to 10 range. So it sounded like he wanted to lock in a profit on that, which, I don't think I'd necessarily want to do that because of taxes, but he may have other motivations for that.
Yeah. So and so Phil Town may still own it somewhere. It's just hard for us to tell. So the fund that, and they're not easy reports to find either, but the funds that do get SEC filings, have to file with the SEC. That's the fund he sold out of, right? So
the Rule 1 fund,
The Rule 1 fund, correct. That's interesting, and it was actually a surprisingly small position for him when he was saying all this really positive stuff as well. It was like a 5% position for him, maybe something like that.
I thought it was less. It was like his second smallest position or something.
Yeah, and Phil Town only owns 10 stocks or something, so like that's small for him. But yeah, I mean, he doubled his money on it even after getting out. So there you go. Actually, something that isn't on my notes, but we did mention earlier, is the short squeeze. Should we maybe talk a little bit about that and then jump into some questions?
Yeah,
or you can speculate on what happened there.
Well, one speculation. There's Karan actually sent me a website. What is it? highshortinterest.com. I thought that was kind of cool. And Seritage, I think it was in maybe the top 20 or so. I'm curious if it's still in there. I'm going to look at that. But
I'll bring that up now.
Yeah, I presume there was just a lot of attention that these companies with relatively high short interest were getting because of the short squeeze. They wanted to pile on to that phenomena, and so that may have been part of what drove the prices up pretty significantly. I mean, it got up to $23 per share, and it went up fairly quickly from maybe like 17, and then came back down, I think, also equally quickly. But yeah, I don't have much to say about it. I didn't dig too deeply into it. What were your thoughts on it, Tom? I don't even see it in the list of top short interest companies anymore.
No, I just looked at that as well. It's not in there anymore.
Yeah.
Actually, I've got Yahoo Finance open. I'll see if it tells me the short interest on there. But yeah, I think you're right. That's probably what happened, which drove the price up, is just everything that had a high short interest was kind of getting squeezed because people got terrified after the GameStop saga and didn't want to be a short seller that goes bankrupt. So I suspect that is what's happened. And
they didn't want to be the next. They didn't want to be the next Wall Street bets target, right?
Yeah, exactly. So yeah, short interest today is apparently 19.2%. So it's still pretty high, but not enough to make that list.
Right.
Okay, cool. I wonder if we start bringing in some questions here. Happy to do that, Brad.
Yeah, let's get some questions going.
Okay, cool. Let's go with this one. Not a recommendation, of course, but here you go, Brad.
He's twisting our arm, isn't he? Or he or she, rising wizard.
Yeah. Would you still buy SRG at current valuations? Well, Mohnish Pabrai had an interesting comment in the podcast. He said, I don't know, the way I interpreted what he said was he'd still be interested in investing in something like SRG at the right price with this new framework. That's how I interpreted what he said, which was something to the effect of, I'd still be maybe interested in SRG today. I don't know how much he was thinking about the price when he said that. But. Yeah,
I feel like part of what's happening there is he's really trying to adopt this mindset of being an owner, right? I think it's more that than, I don't think he sees it as a spawner. I mean, he mentioned in this podcast that he did with Stig that, it's possible that Seritage becomes one of these, what does he call them, recyclers, funeral services businesses, where, they're able to target these single-story retail, and they really have a process for converting those into mixed-use, multi-story, and that becomes their business. And that's kind of a spawner type business. But that to me is a bit of a stretch to take them from where they are today to becoming that. So I don't know. I think there's some bias there that's coming through in him saying that.
Yeah, I agree. I think that's a stretch. Maybe it'll happen. Maybe SRG will become the redevelopment engine of the US real estate market.
Could be.
I'm not betting on that. Let's put it that way. Actually, one thing I forgot to mention with the C-suite reshuffle is that there actually was at least one person in that reshuffle that got the boot. Or at least that's my interpretation of what happened. Which is a guy called James Pabrai, who was actually his title previously was the Executive Vice President of Development and Construction. So that's a very interesting role to, I guess, see someone leave from. So perhaps the Andrea Olshan is, I don't really know how to interpret that. Maybe she's lighting a fire under someone after making that move. So
yeah, maybe she had to send a message, right? Shake things up.
Yeah, they got to get things into gear. So
I don't think we're going to get a lot of transparency on that anytime soon.
No, neither do I. I did find his LinkedIn. Maybe we should flick him a message or something.
Who?
Ask him what happened.
Oh,
the guy that got kicked out. So.
Yep.
All right, let's move on to the next comment. Doesn't seem like SRG is a cinch.
No.
This is another Mohnish Pabrai recent talk thing he's added to his checklist, right? He's looking for things that Charlie Munger would call a cinch. Yes. Mm-hmm. Is SRG a cinch, Brad?
It was I don't think it's a cinch at current prices. I mean, you know, there are things that have to go right. Like Phil Town said, it's not a 6-inch hurdle, right? It's not a 6-inch bar. But I think if you can get comfortable with the properties and what they're worth, and you know what they could be worth in 5 or 10 years with a competent team, you know, redeveloping them, it's compelling. I think it is an asymmetric upside to downside, in my opinion, but it's not a cinch, I would say.
Yeah, agreed. And this is perhaps a good follow-on question from Tom. What are your warning signs to sell if things get dire? It looks like they'll be selling many properties over the coming years to fund those core projects. Would it be something like Pabrai or Spear selling that would cause you to sell?
Yeah, I think that's a great shortcut for me at this point. You know, why not outsource to these incredible investors who, you know, have a lot more experience digging into the company than I mean, Pabrai owned it back in 2017, right? They've done a lot of work on it. Of course, we should all do our own work. But when it comes to selling, I mean, selling is just so much harder than buying. And, you know, if we have these shortcuts, like being able to see when these gurus are, you know, hitting the road from a company, I think that's a powerful model for selling, to knowing when to sell. I don't think I wouldn't automatically eject, but I would take a real good look at what's happening and look for smoke, right? Look for warning signs.
Yeah, agreed. And I guess, like you say, people sell for a lot more reasons than they buy. Like they buy pretty much because, in the case of the investors we're talking about in this context, they buy because they think something's really undervalued and they're going to get a safe, high return over a period of time. But they can sell for many reasons. So, you know, if we saw Pabrai sell half his position or something, but then we also saw an equivalent dollar amount of a new position pop up, that's a far different thing to SRG just being wiped and then seeing no, you know, equivalent addition to the portfolio. So I think we've got to put it in that context. And the other thing from my perspective is I agree with a lot of what you said. I largely am just keeping an eye on what these guys are doing. But also, I guess we've got to keep a close eye on what we've discussed here with the redevelopment projects and make sure that they are actually quantitatively making some progress on this and it doesn't just keep dragging on for years and years and years. And I personally would actually put more weight probably on Guy Spear than Mohnish Pabrai in terms of selling, because Guy Spear's superpower seems to be just never selling unless he really needs to. So whereas Mohnish Pabrai is maybe, of course, still a long-term investor, but has a history of maybe being a little bit more active and a little bit perhaps more open to risk, I would say, than Guy Spear. So if I see Guy Spear still in there, I think I'm pretty comfortable to keep riding that one.
Yeah, I mean, if Pabrai finds another racist or something that he thinks is going to be a 100-bagger in the next 5 to 10 years, I don't think he would have too much hesitation. If he didn't have funds ready to go, I don't think he would hesitate very long to sell Seritage. So yeah, we got to keep that in mind. Knowing what his new framework is, he's looking for some, you know, pretty impressive asymmetric upside to downside scenarios. So if he finds something like that, bye-bye Seritage is my opinion.
Yeah, pretty much. Okay, I'm going to throw up a comment from Jack here. I think this is actually a really good point, which we perhaps maybe haven't considered or at least spoke about directly here. So Jack says, if you're treating the properties not yet sold as cash already, I'd make sure to discount appropriately because of the holding costs in the meantime, transaction costs and risk of prices falling. What are your thoughts on that comment from Jack?
Yeah, I mean, I guess it's different if it's a property that's just sitting vacant versus if it's a property that, you know, there's activity happening there. Like there's a tenant and there's costs as well. So yeah, I think it's vary the situation with that. It's just as likely though, or just as possible that prices are going to rise versus prices are going to fall. So I don't know that I would put more weight on the possibility that prices are going to fall. You know, those are some of my thoughts.
Yeah, I think certainly if they've got empty properties which are just burning cash sitting there, perhaps that's something to consider. But if they're rented out and profitable and they're spinning off those units, I don't know that I'd be putting big discounts on that really. But it's an interesting thought. And I guess one of the things we spoke about in the first stream is that, you know, SRG, in our opinion, was potentially trading at half of, you know, a liquidation value. So there's already some margin of safety built into it by simply just buying it at that bigger discount.
Right.
Right.
Yeah.
Okay. Keep your questions coming, everyone.
Great questions.
There's a really good. I'll see if I can find some more. Let's see. We've got a comment from Jennifer saying she read the same thing about the 2 million square feet versus Pabrai's 3 to 4 million discrepancy. So good to see we're not the only one there. Right. Let's see. And Frank's also saying he looked at Open Insider in regards to the Eddie Lampert stuff. So hopefully we're on the right track with him not selling 25% of his position. This is a bit of a follow-up to the cinch. So does the manager have their feet up on the desk at SRG?
They better not.
Yeah, they better not. Yeah, it's really not not that type of business yet, is it? Hopefully at some point it will become that, but certainly not right now. And that's actually, we've powered through a lot of the questions there. I've skipped over a few, but I think we've largely there's a fair bit of overlap between a lot of them.
To Frank's point, I don't think Open Insider does factor in the OP units for SRG. And really, I mean, even Value Line, you know, some of the sources I like best for insider ownership, they're not going to catch what's happening with SRG. So you've really got to know that nuance about this particular business.
Yep, agreed. Are there any interesting questions you can see there that you'd want to pull up, Brad?
Let's see here.
While you're having to think about this, I'm going to throw up another one from Frank, because Frank should not apologize for this at all. This is exactly what we want from comments, which is
more bears.
Yeah, that's all we want. Like, Brad and I are both fairly familiar with the bullish side of this investment, and we can see the light at the end of the tunnel. But if you can see anything that's, how do we complete this analogy? Anything that's going to tackle us as we try to go through the tunnel, that would be great. So yeah, we're both big Charlie Munger fans of inverting investment ideas. So the more bearish arguments that we can hopefully counter, even better than you argue towards us, that would be great.
A few questions from Andrew. Do you plan to post the recording of this video after? Absolutely, it will be posted after.
Yep, and this is obviously on the Investing with Tom channel, but if you don't already follow and if you're not already subscribed to Brad, I'm not sure what you're doing, but you should definitely head over to Brad's channel and subscribe as well. So, but yes, the replay will be posted, definitely.
So Chirag says, when you are valuing the commercial properties, please factor in risk of office spaces being vacant. So yeah, that's a consideration as we enter, kind of a new, who knows what's going to happen in terms of how many people are going to go back to the office versus work from home. There's a lot that still has to play out around that. Your thoughts on that, Tom?
Yeah, agreed. I think, we've hopefully already priced that in by potentially being conservative with the square footage on that Dallas property and just being more conservative with the rent that we used. We could easily push that closer to $30 a square foot in the example I gave, but I think we use 25, or even if you use 20, it looks pretty good. So, again, there's margin of safety kind of built in a lot of places along the way here.
So a question here from Santiago. Do you know who Thomas Tisch is? He owns 7% of SRG. I don't. I don't know Thomas Tisch. Do you have any awareness of him, Tom?
Never heard of him, and I feel kind of bad saying that if he does own 7% of SRG. No, not familiar. But
a Sears director. Okay, a Sears director.
Yeah, okay. I will jot down that name now to look into at some point. But no, I don't. Not familiar with Thomas Tisch off the top of my head. Okay. Frank is asking about his cash burn question, so I'll pull that up. SRG cash burn is around 120 million annually, which is about $2 per share. So discount to net asset value is perhaps justifiable. When do you expect strong improvement in NOI that would be needed? Thoughts there, Brad?
No,
Frank is the master of hard questions, actually.
Oh God, I've got to block him from my weekly Q&As. He's let up on me a little bit recently, but it's really tough to come up with accurate estimates in the short term in terms of like how quickly our NOI is going to grow and things like that. So much of that is based on execution. And obviously there's a ton of factors that go into executing these redevelopments. So it's a big question mark. And I think it's a big reason shares are discounted. There's this uncertainty, but I think as we see it, Tom, there's not a lot of risk, at least where we bought in. So it's that market confusing risk and uncertainty in my opinion.
Yeah, agreed. I think there's some downside protection from just the asset value. But of course, if this cash burn continues forever, that margin of safety kind of continues to erode. So it's a very good question. I guess if you think about this in the context of, I need to dumb these down for my pea brain. The way I think about this is, if I were developing some property down the road from my house, right, when I first go through that project, I'm going to spend a lot of money up front, have no income, so there's clearly going to be a lot of cash burn. But on the other side, the costs obviously go down very, very significantly because I only have to develop the property once, and then of course the income is going to go up as it starts getting rented out. So I guess to put it in very simple terms, and I don't know if this answers your question directly, Frank, but at some point, the redevelopment spending is going to stop or slow down very significantly. And at the same time, there's a lot of rent that's going to come online. And the way that we have to look at that as investors is say, how quickly do we think these properties can come online? How much do we think they're going to have to spend to get them there? And what rent are we going to see on the other side? And that's kind of what we're trying to work through with the Dallas property and some of the other properties at the moment. So I think if it's not a business where you can just pick out one quarter and say, oh, they had a bad quarter because they've burnt all this cash. It's you have to look at it over a multi-year time horizon.
Yep.
Cool. Any other questions you're seeing come through there, Brad, that we should be throwing up? If you've got any final questions, everyone, keep throwing those up.
Jesse asked, would the cash burn reduce as they get rid of properties that are not useful? I think it's a way to fund their needs for cash in the short term, right?
Yeah, it's again, it's kind of goes back to I think what Jack said earlier around discounting some of the properties to account for a few different things. I think it depends which properties have been sold off. So yeah, if they're vacant buildings just sitting there, then that's then sold off, then that would reduce the cash burn slightly. But the large source of cash burn is redevelopment. So that's going to be the major thing that would slow that down.
Yeah, let's see if there's any others in here. When will we be having another live video on SRG, Tom?
Yeah, and I'll throw up another one here, which is kind of funny from Copy Traders Club, who I think is I hope I'm not getting this wrong, but I think this is Gavin, who has a recent podcast by the same name, Copy Traders Club. So go and check that out if you're interested. I think Karan was a guest on there, actually.
Yep, he was.
Yes. So anyhow, his question is, are you planning to keep us informed about SRG for the next 8 to 10 years? What do you think, Brad?
Yeah, I mean, if I hold it that long,
yeah,
I could see us doing every 6 to 12 month kind of, where are we at now with Seritage? I don't see why we wouldn't do that if we're still holding for 10 years.
Mm-hmm. Yeah. I think, I mean, there's quite a few things that have changed significantly since maybe there's a couple of things that have changed significantly since we did the last live stream. The management is an obvious one.
Yeah.
And I guess we've changed how we actually think about the investment. So that's not necessarily something changing with SRG. That's something changing in our heads about how we think about SRG. So if things like that come up again in future, then certainly. Hopefully we're still making YouTube videos and doing this stuff in 8 to 10 years.
Yeah, we got to capture the compounding, right, Tom? We got to be in it for the long run.
Absolutely.
Tom Hooper, by your estimations, have the recent sell-offs been around market rate, or have they been desperate sales? My understanding, based on the average sale price for the properties, is they've been pretty close to what I estimated for value. So I don't think it's that Seritage is desperate and selling these off in a fire sale. I think their market rate would be my opinion on that.
Mm-hmm. Cool. And yeah, I don't know that we're going to have an answer to this one, but I always want these types of I want to hear thoughts behind these types of comments. It's easy to put a statement out there like that, and we could just as easily say the exact opposite. But we're trying to give as much of our, I guess, logic behind that as possible. So if you've got some bearish thesis, share all the highlights, and we'll be happy to respond to that. Or if there's anything that you think we haven't thought of that we should be thinking of, then throw that.
Yeah, shoot us a message as well, offline with all your bearish points. Love to check those out.
Yeah, we're super open to hearing about this stuff. I mean, we talked about investing mistakes on the Punch Card Investing YouTube channel a couple of weeks ago, and mistakes are par for the course. So if you can explain to us why you think that SRG is going to be a mistake, then I'm happy to hear it. So another question here: what is your average buy price of SRG, and are you planning to add more stocks if it goes further down, or more shares, I suppose, as it goes further down? Do
you want to share your average buy price, Tom, or is that confidential?
No, I don't know it to the cent off the top of my head. I think it's somewhere in the $12 range, but I will bring that up on my phone now. I think you mentioned in the last stream, your initial purchases were around 10. Is that right?
$10.07.
Okay, let's see. I was a bit later to the party, so I'm $13.20 is my average purchase price.
Great.
And what was the second half of that question? Would you plan to add more? So, yeah, I mean, I made SRG actually a relatively small position by my standards. It sort of depends how you measure the size of my portfolio around whether you include cash or, I've got other cash for like a house deposit and stuff at the moment. So it depends how you measure what you call my whole portfolio. But maybe something like 7 or 8% at cost is where I had SRG, which is a unusually small position for me, actually. I've been closer to 30% in some stocks before. So, hearing this expansion of the way that they think about SRG from Guy Spear and Mohnish Pabrai has actually made me interested in potentially adding more, but we'll have to see with that one. How about yourself, Brad?
Yeah, I got in, I think it was around a 10% at cost position in my portfolio, and I'm pretty comfortable with that size. I don't think I would add more. Maybe if it went down below like 7 or something like that, but it has to come down quite a bit for me to get interested again, just because I have a fairly comfortable position in it already. Phil Town portfolio update. When is that coming out? So I think His last one was the end of March, if I'm not mistaken. You guys can look back at our videos. Both Tom and I made an update on that when Phil Town released his last one. But I'm not clear on the rules even for the Rule 1 fund, like when that has to be released. It seems later than all the 13Fs come out. So, and it seems kind of random when it actually comes out. So I'm not sure.
Yeah, I always find that impossibly difficult to find. I think in every case except one, someone else has kindly sent it to me, so I don't have to hunt through through the SEC filings. Let's maybe make this one the last question, Brad, then we'll wrap it up, because this is an interesting one that we haven't touched on. So inflation impact on real estate like SRG. Do you have any thoughts on how high or even low inflation may impact SRG?
Yeah, well, so there's something that I learned about a number of years back called inflation-induced debt destruction. And essentially what that means, if you have debt, say on real estate, for example, as inflation occurs, you're paying that debt back with kind of original loan dollars. Okay. So it's a little wonky for me even to explain it, but inflation benefits people who have debt, provided that debt, is responsible debt, and you're going to be able to pay it back and all of that, right? So that's, but again, how does that play out with Seritage, where, they don't own the finished real estate today, right? They still have to put a bunch of money into redevelopment. So there's kind of two sides to it. I'm not sure that there's a clear win in the case of Seritage.
Yeah, I tend to be of the opinion that that inflation would be really helpful for Seritage, which Jack's actually said in the comments in slightly better language than I did. That one, inflation would be a gift for debt-laden SRG. So, yeah, like you say, Brad, if you're borrowing money in today's dollars and then paying it back in
tomorrow's dollars,
in tomorrow's dollars, then that tends to work pretty well if there's been a lot of inflation. So, for example, if your debt servicing is, say, I don't know, I'm just ballparking numbers here, and these aren't for SRG, but if your debt servicing costs is, say, 40% of your rental income today, but then you go through a period of large inflation and your rent goes up and so on, it could potentially go down to maybe 20% of your rental income and so on. It gets much lower as a percentage of, those future higher rental prices.
Right, because your debt interest stays the same, and you've got rising rents. Yeah.
Yeah, and then you've also got rising asset prices, hopefully, as well. So that sort of, if you have constant debt, even if you don't pay down any of the debt, if you have constant debt and the asset prices are going up, then your equity, if you own shares in SRG, is also growing at quite a rate as well. So I tend to think it would probably be a positive for SRG if it happened. But like you say, at the same time, they've also got to use cash to fund development as well. Right. So potentially those development costs may also go up.
Right. And if you guys want to learn a lot more about inflation, next week on Punch Card, we're going to talk about how different great investors approach high inflationary environments with their investing. So stay tuned for that next week.
Yes. So if you've watched through to this point in the stream, which we still have about 60 odd people on here, you've got two tasks after you end this stream. So firstly, you have to go and subscribe to Brad, and then secondly, you have to go and subscribe to Punch Card Investing. Those are your two bits of homework, and I promise it's not going to be an all-nighter. It's going to take you just a few seconds. So head over to Brad's channel and also Punch Card Investing if you're interested in seeing that. But I think that's probably a pretty good place to wrap it up there, Brad. So big thank you to everyone who tuned in, and like we mentioned earlier in the stream, the replay will be up for you to go back and watch. And big thanks to you as well, Brad, for joining me for this update. Hopefully we can do it again in the future.
Tom. Yeah.
Great. All right. We'll see you guys next time.
See ya.
So yeah.